capital analysis is to make a clear distinction between capital goods and capital value, and then to show the relationship between capital goods and capital value. We know, of course, that capital goods are means that are employed to attain ends, and that they are indirectly serviceable in the attainment of an end, and are distinguished then from consumer goods, which are directly serviceable. So means can be categorized into consumer goods, we directly use to satisfy our end, and producer goods, which we use to make the consumer goods that satisfy our ends. And these producer goods then can be further divided into original factors of production, labor and natural resources or land, and then the produced factors of production, which are capital goods. So the capital goods are those physical tools, equipment, intermediate goods in production processes, steel, let's say, that's eventually going to be made into an automobile and so on. Now, there are causal laws that relate means to ends, and in one sense, these causal laws are important to grasp for each production process. Professor Salerno has talked about one of these causal laws already. This is the principle of marginal physical productivity of the factor. If factors are combined with complementary factors in production, and if variable proportions exist so that different amounts of the factors can be combined to make the good, then it's possible to calculate the marginal physical product of each factor. We simply take away some of the factor and see how much output goes down, or we add some of the factor and we see how much output goes up. The marginal physical product of the factor is the addition to output that comes about by adding the factor in production. Now, in addition to marginal physical productivity, which is one of the causal laws relating means to ends, there's also the degree of specificity of a good. So goods can be more or less specific to some particular production process. Some means then are less specific, so that when we move them from one production process to another, not much productivity is lost. Generally speaking, labor tends to be the least specific category of factors of production. So we can take a worker and move him from an auto assembly line to manufacturing refrigerators or something else, and the labor's productivity is intact by and large. But other factors, capital tending to be the most specific general type of factor, if you try to move the factor from one production process to another, a great deal of its productivity is given up. So if you have a cigar making equipment and you try to transfer it into the production of automobiles or something else, your productivity will be nil, right? So this is every factor, labor, land, capital goods, all have a degree of specificity. And the degree of specificity can vary within each category of factor. Some labor skills are more specific. Some capital goods are less specific than other capital goods, and so on. So this has to be taken into account in any theory of capital. And then finally, the third factor here for a factor of production is durability of the factor. So factors exist in different durabilities. The durability just referring to the span of time over which the factor generates its productive services. Some factors last 10 years, some 30 years, others have less durability. Now, the second arena, theoretically, in which we need to discuss the causal laws of physical factors of production is in the structure of production. And that's what my diagram is designed to illustrate. Professor Salerno gave you a simple structure of production for Robinson Crusoe yesterday when he was talking about how Caruso might acquire a net by engaging in steps or stages of production. So the production structure is the sequence of productive steps from what we call the higher stages on the top of the diagram, where primitive capital goods are made. And these primitive capital goods tend to be less specific than the sophisticated capital goods that are produced at the lower stages. So iron, for example, mined out of the ground is useful in many different production processes, but a steel fender that goes on a Honda Civic is useful only for that production process. You can't transfer it even into the productivity of any other automobile. So as we go from the top of the structure of production down to the bottom, the degree of specificity of the capital goods tends to increase, and each of these production processes is related to the others. These are causal relationships between them. We have technological processes by which iron is made into steel, and steel is molded into a fender, and so on and so forth. Now, in addition just to this description, briefly, what I want to point out in a point that's different than the production structure that Professor Salerno gave you is that when we're talking about the production structure across the division of labor, the production structure becomes much more complex. It becomes lengthier. That is, there are more stages and longer production processes set in motion. For Caruso to make a net may take a couple of weeks. But to make an automobile from the beginning of mining the iron out of the ground until the car is actually sold as a consumer good might take years. So production processes become longer, they become more complex in the degree of interrelationships among the different uses of the factors. The steel that's produced in the production structure can be used in various ways, automobiles and making buildings and refrigerators and so on. So there are all sorts of interrelationships that have to be taken into account in talking about the structure of production and in talking about then capital theory. Now, one other point about the structure, as Professor Salerno pointed out, production moves from the top of the structure down. We mine the iron first, we make the steel fender, and then we eventually make the car. But evaluation goes in the opposite direction. So when evaluation is made of the different goods in the production structure, we value the car, and we value the steel fenders or the tires, and we value the rubber, and so on and so forth. Evaluation begins with the consumer. Only when we know the value of the consumer good, the Honda Civic itself, can we then assess the value of its component parts, the labor that went into making it, and tires, the paint, the steel, and so on. And then only knowing the value of the tires can we know the value of the rubber, and so on and so on. Values imputed from the consumer good backwards, so to speak, to the factors of production. Now, this raises one problem which we won't go into in this lecture. It'll be dealt with in other lectures during the week. That has to do with entrepreneurial foresight. Because it's quite obvious that there's a problem involved here. And I might revert briefly to illustrate this problem to Caruso again. Let's say Caruso sets out to make a net. And he has in mind then these causal relationships that he has to engage in, mixing his labor with the land to make the net. So he has to go through various stages, right? He gathers up rope, and then he finds a twine or something that he can weave the rope together into a net. And so he goes through these processes. Well, all of this is subject to his entrepreneurial foresight. In other words, he has to have in his mind an anticipation that all of these production processes will work out so that the value that he anticipates in having the net is realized. He has to set in motion the production processes before he can realize the value of his production. And this is somewhat difficult for Caruso. It's somewhat difficult for you and I when we're engaged in action. But it's categorically more difficult in the structure of production. It's one thing for Caruso to predict how over a week or so his action will work out. Or let's say you came here to the Mises Institute how your week will work out. What the value that you anticipated when you came here will be realized by the end of the week or some other time in the future. But when we engage in a production structure in the division of labor, the production structure is longer. It's lengthened out. And so we're mining iron out of the ground years before its value is realized. And how is it possible then to properly value the iron today that will only have a realized value years in the future? Well, this is done by entrepreneurs who specialize in this process in the structure of production. At each production process, we have an entrepreneur, a group of entrepreneurs. The entrepreneurs at Honda, the entrepreneurs at Michelin, and so on and so forth. Each making profit calculations about how to arrange their production processes, what type of consumer good to make, and so on and so forth. And these production processes are interconnected by economic calculation. When Michelin, for example, sells its output to Honda, the finished tires, that's revenue for Michelin, but it's a cost for Honda. Right? So we get an intertwining of these calculations across the structure of production. So if I'm producing iron at the beginning of the process, I don't need to know what the value of cars will be eventually in 2 years as an entrepreneur. I just need to know what demand will be when my production is finished by the steel company. The steel company worries about what demand is at the lower stages, right? When fenders are produced and so on and so forth. So we have a tying together of all the production processes because we have separate entrepreneurs making economic calculations at each production process. And all of these calculations are intertwined. We might envision this process of the production structure in terms of the problem of economic calculation in socialism. We would have a central planner trying to erect a structure of production. And you can see the problem, well, at least one of the problems that he would face, is precisely this problem of having to project a lengthy production structure into the future, his expectations, anticipations about the realization of the value of this thing. It would be a very difficult process, absent from having separate entrepreneurs who are able to do this step by step, just in their own production process. Now, we might then note briefly, before we go on to talking about valuation, 3 features of this production structure. One, we say the production structure is complex. And by complex, we mean it has a huge amount of detail in it. It has a huge number of specific goods, capital goods that are produced from the higher to the lower stages. If you take apart an automobile, it has maybe 1,000 parts. All those parts have to be produced. So my diagram would have to be greatly expanded, right? I don't have just 3 production processes in the second stage. I have maybe 1,000. And then so on and so forth. We just get a multiplication as we go up the stages. Since each first stage capital good has to be produced by combining numerous capital goods itself, each of which has to be produced. And once again, how can the production structure be complex? How can it expand into this vast complexity? And the way in which it expands into the vast complexity is, I mentioned before, that each production process is overseen by one entrepreneur or one group of entrepreneurs. And so decisions about how to arrange production of the car, or how to arrange production of the tires and so on, is made by one entrepreneur. One entrepreneur can handle that, right? One person can decide about what the efficient means of production are, what the value of the good will be, and so on. But if we had one central planner trying to decide this in total, this would overwhelm him. In fact, one person probably couldn't even memorize the parts book of a Honda Civic, let alone all the other goods that exist within the structure of production. In our economy, the estimate is that there are roughly 2 million different types of consumer goods that are made. Not units of production, but different types. And so in our economy, we have 2 million of these diagrams. Each consumer good is different. It takes us at least a slightly different structure of production to make. Now, second, we notice that the production structure is flexible. By flexible, we mean it can change. It can change because all of the production processes, as I mentioned before, are undertaken because they're mutually profitable. Michelin produces the tires because Honda makes it profitable for them to produce the tires. This permits Michelin then to demand the rubber, and thus makes profitable the production of the rubber by some other company, and so on and so forth. So if Honda, let's say, wishes to change the specifications of the tires that it puts on Honda Civics. Let's say it remakes the Honda Civic in new model year, and they want bigger tires. They had 15-inch tires before, now they want 16-inch. So that demand requires a change in the production by Michelin. Why do they change the production structure? They change it because Honda's demanding this change. Honda makes it profitable. And so the very fact that there's mutual profit involved among the different entrepreneurs in adjacent stages permits the structure of production to be flexible. Again, we might think of this feature of the structure in contradistinction to central planned economy. In a central planning economy, we have a rigid structure of production, such as it is. This is because it has to be planned out in advance. You can't deviate from the plan, or any deviation causes bottlenecks and dislocations and so on and so forth. Now, finally, we notice that the production structure is coordinated. The production is harmonized or coordinated throughout the structure. In a market economy, we don't see bottlenecks. We don't see, overproductions and underproductions and etc. Once again, this is a result of the cooperation that exists among entrepreneurs in adjacent stages. Since they are cooperating with one another to earn profit, they coordinate their activity, as I mentioned before with Michelin and Honda. And also this coordination comes about through the process of competition. Competition is a coordinating or a harmonizing factor in the structure of production in the economy. Lots of different manufacturers in the lower stages compete for steel. And this competition directs the steel producers to allocate the steel where it's most highly valued, where the bids are the highest by the first stage producers. And so this is an act of coordinating how this factor is allocated or rationed across the different uses. Now, quite obviously, all of this talk about physical laws and seeing the physical connection between things in the structure of production is not sufficient for these allocation decisions to be made. And again, I've already discussed that this is all done really in the framework of economic calculations of profit and loss. But in order for there to be calculations of profit and loss, we have to have prices for the factors of production. And we have to discuss or give a theoretical explanation for two different types of prices. This is because factors of production have two different types of prices. They have rental prices, which is self-explanatory. This is the price you pay to rent the services of the factor or to purchase the services of the factor. So all factors of production have rental prices. These rental prices are based upon what we call the marginal value product of the factor. The marginal value product of the factor is the revenue that's earned by using the factor in production. Now, clearly, this must be the basis for the rental price because entrepreneurial demand is based upon marginal value product. Now, the marginal value product is divisible into two parts. The marginal physical product of the factor, how much extra output is added in production by adding the factor, and the value of the output. Now, as we spoke about yesterday, it's only because the P, again, once again, is the price of the output produced, not the price of the factor, just to be straight. It's only because prices exist in the market, that is to say we have a monetary economy where prices exist for things, that we can make the marginal physical product of different factors commensurable. Otherwise, the marginal physical product of different factors, since each factor is heterogeneous, you have, again, equipment that you use in manufacturing an automobile, and you have labor and natural resources. They're all denominated in different units. And hence we could never compare the marginal physical product directly of these different factors. This is only possible because we have a price system, so that we can transform marginal physical product into marginal value product. Now, as I mentioned before, the reason marginal value product is the basic factor behind demand for the factors of production is because entrepreneurs assess the marginal value product of the factor. This is what they're interested in. If I hire a factor of production, how much does it add to my revenues? How much more output does this factor produce, and what's the output worth? That's what they want to know. That's how they earn profit, is by hiring factors of production at knowing what their marginal value products are. So no entrepreneur, we know that no entrepreneur would ever pay a factor of production more than its marginal value product. If it paid more than its marginal value product, the entrepreneur would suffer a loss. So we know that rental prices could never be higher than the marginal value product. But why aren't they lower than the marginal value product? Why can't an entrepreneur exploit the worker by paying him less than he's worth to the firm? Well, this is because of competition. Because there's a market for these factors of production. And other entrepreneurs are bidding for these factors of production. Other entrepreneurs are bidding for the labor, they're bidding for the capital goods, for the natural resources. And since they're willing to pay the marginal value product of the factor, or at least up to that point, and since one price always exists for each unit of a homogeneous factor or homogeneous good in the market, all entrepreneurs pay the same rental price for the factor. Now, this also means that if the demand, let's say the marginal value product of the factor, and thus the entrepreneurial demand for the factor, was greater in some industry. Let's say there was a huge increase in the demand for Honda Civics. And so the marginal value product, since the value of output's gone up, the marginal value product of labor, let's say, in producing Honda Civics skyrockets. Well, then Honda has incentive, of course, since they can buy the labor at the rental price and then receive this higher marginal value product by selling the output, they have incentive to hire more labor. But of course, as more labor is allocated into Honda's production process, its marginal value product goes down. This is the law of diminishing returns, right? We're adding more of a variable factor to fixed factors. The marginal physical product of the factor falls. And so we get a reallocation of the factor from where it's less valuable to where it's more valuable, and a realignment of the equality, the rough equality of marginal value products across all uses of the factor in the economy. This is what the market tends to do, get this allocation process in an economizing way where the factor is allocated to where its value is the greatest. Now, there's one other thing that we have to mention about rental prices. We said rental prices are based on the marginal value product. It didn't say they were equal to the marginal value product, because there's one other factor we have to take into account. And this is discounting. So DMVP is the discounted marginal value product of the factor. So rental prices are actually equal to the discounted marginal value product of a factor. Now, why is this so? Well, this is so because of the time element involved in production that we've already mentioned in the structure of production. Each production process takes time. Factors of production have to be hired into the production process, though, in advance of the receipt of the revenues that are earned from selling the output. So Honda hires its workers, they pay workers, but workers are producing cars today, they're working on cars today, that won't be sold for 6 months or 8 months or sometime in the future. So the capitalist entrepreneur is putting money into the production process up front. They're spending present money in order to pay factors of production. But the benefit of hiring these factors of production is only to be received in the future. Therefore, they discount the payment that they give to the factor of production. It's as if the capitalist is lending money to the factor owners in advance of the receipt of the future money that will be earned by all factors in the production process. So, entrepreneurs are not willing to pay marginal value products for the factors. They're only willing to pay discounted marginal value products. This then permits us to look at the profit calculation in the following way. We know that the monetary profit of producing and selling a good is the revenue, the total revenue that's received from the sale of the good produced, and the total costs incurred in hiring the factors necessary for production. We've also pointed out that these costs are incurred sooner and the revenues later. These aren't coincident in time. The costs are paid earlier, and thus, again, the rental prices have to be discounted. We also know from previous discussions that these revenues and costs all come from the market. So there's a market for Honda Civics, and there's a certain price that's set by consumer demand and a certain quantity that's permissible because of the extent of demand. Price times quantity gives us total revenue. And likewise for factor markets. So there's a price of labor and a certain amount of labor that's used in production. This price of labor is set in the labor market, so on. There's a price of these capital goods, a price for tires, a price for steel fenders, a price for paint, and etc. The price for the natural resources. And there's a price of time, which we'll talk about this afternoon. We'll talk in detail about the interest rate and time preference. But that last entry just refers to an interest expense that's involved in production. So let's say that using this structure, we have the following situation for a manufacturer. He has a production process where he uses capital, natural resources, and land. And let's say he estimates the marginal value product of the capital good is $10,000. The marginal value product of the natural resources used is $5,000. Marginal value product of the labor he uses is $2,500. And so he has a total cost in terms of his marginal value product. I shouldn't say total cost, but he has a total value of inputs that he uses of $17,500. And let's say that the production process takes 1 year. So he's going to pay these factors of production, their discounted marginal value product today, and then he'll reap these marginal value products at the end of the year. And just to do the calculation, let's say that the rate of interest is 25%. And again, this afternoon we'll talk about how the interest rate is determined. Well, then he calculates the discounted marginal value product simply by discounting or deflating or lowering the marginal value product of each factor by 25%, right? If he's earning 25, or the going rate of interest is 25%. So if we deflate the 10,000 by 25%, we divide it by 1.25, we get 8,000. That would be the discounted marginal value product of the capital. Of the natural resource, it would be 4,000. Of the labor, it would be 2,000. And then the time element involved, we said that the price of time, the interest rate was 25%. And we now see how much money has to be put up front by the capitalist in order to engage in this production process. It's $14,000, right? That's what the capitalist entrepreneur will pay to hire these factors of production to reap these revenues. 25% against $14,000 is $3,500. That's his time expense. Maybe this entrepreneur has to borrow the money, the $14,000, to hire the factors of production. The market rate of interest is 25%. So he has to pay an interest expense over the year of $3,500. Now you'll notice that in this production process, the way it's been structured, he's earned no profit at all, right? He reaps $17,500 when he sells the good. That's the sum of the marginal value products of the factors. And he pays, including the time expense for all of the factors of production, $17,500. Okay, so rental prices are equal to the discounted marginal value products of the factors. And these rental prices are sufficient for economizing the use of existing factors of production across the structure. That's all that the entrepreneurs at Honda need to know to arrange their production process as it exists. What's the labor market price of labor, price of the steel, fenders they use, the paint, and so on and so forth. Then they can judge which suppliers to buy from, what specifications to use for the different parts, and etc. But this leaves open the question of changing the structure over time, of engaging in building up the structure of production over time. Rental prices are sufficient for allocating existing factors, but they're not sufficient for engaging in a process of building up the structure, that is, changing the capital structure itself. For that, we need to have the second type of factor price that I mentioned before, the purchase price of capital goods. We need to know not just the rental prices of capital, we need to know their purchase prices. Now, how do we give an explanation then for the purchase price of capital goods? Or the purchase price of a durable factor of production. Well, we need to answer the question, what would an entrepreneur be willing to pay not to rent a capital good, a piece of equipment that that Honda uses in manufacturing Honda Civics, not the rental value of this capital, but what would Honda pay in order to buy it outright? Well, to buy it outright, Honda would not receive just the marginal value product of the factor over the rental period. It pays, an hour for each worker and receives the marginal value product of that worker for that time period. But would receive all of the marginal value products that are produced by that factor over its lifetime. Now, as we've already shown, though, the entrepreneur clearly will not pay today in present money an amount to buy a factor that's equal to the sum of its marginal value products, right? Because these marginal value products will only be realized in the future. But the purchase price then would have to be equal to the sum over the life of the capital good from first period to the last, n just being the time period, of the discounted marginal value product of the factor. So this would be the purchase price then of the capital good, or any durable good. This works for even a consumer durable good. How much does a person pay for a house to buy it outright? How much does a person pay to rent the house? Well, the purchase price would have to be related to the rental value of the house discounted through time. Now, clearly there are four factors then that affect the capital value. Capital value is just a term we use to refer to the purchase price, the market value, or the purchase price of a capital good. There are four factors that affect this. The four factors embedded in this discounted marginal value product. One is the productivity of the factor. Right, that's the marginal physical product. So if a factor is more productive, its purchase price would be higher. If it's less productive of services, its purchase price would be lower. There's the value of the output. This is the P factor we mentioned before. These together make up a marginal value product. So if a factor produces a more valuable output, then that factor's price would be higher. If it produces a less valuable output, its price would be lower. Then there's the durability of the factor. This is the N term in the formula. A factor that's more durable would have a higher price than if it were less durable, other things the same, because the future stream of marginal value products will be longer or larger. And then finally there's the interest rate. The R term. Now the interest rate varies inversely with capital value. Right? At higher interest rates, there would be a larger discount that entrepreneurs or capitalists would take into account when paying for capital goods. So they would pay less for a capital good of equivalent future marginal value product if the interest rate is high, simply because present money is worth more than the future money they could get, relatively worth more. And vice versa. If interest rates are lower, then capital values are higher, precisely because there's a smaller discount of all of those future marginal value products that will be earned by possessing the capital good. So we're at the point where we can take in some detail this connection between the rate of interest and capital values. You notice that the rate of interest, unlike these other three factors, is a general cause of the change in capital values across the economy. If, let's say, demand for Honda Civics goes up, then the capital value of Honda's production process would rise. This would be a factor specific to that production process. But if the interest rate goes down, then all capital values go up, regardless of the production process. All future streams of marginal value products are worth more. So economy-wide effects occur through movements in the interest rate, economy-wide effects on purchase prices of capital goods. Notice movements in the interest rate don't affect the rental prices of factors. You pay the same rent for the factor. But they affect purchase price. Now, this discounting that's involved in purchase prices of capital goods also explains some features of reality that would be inexplicable otherwise. For one thing, it explains why land prices, purchase prices for land, are finite. Land has essentially infinite productivity, right? Thousands of years, certain plots of land have been producing crops, presumably wood for thousands of more years. So why aren't land prices today capturing all of these future marginal value products? Well, how much will an investor pay today to get $1,000 of a marginal value product from a plot of land in 1,000 years? Zero. Right? After some point, the discounting becomes so heavy in the future, and again we'll talk about why that's the case this afternoon, that far out into the future, marginal value products are worth almost nothing in present terms. And so we get land prices that are finite. In addition, this discounting process explains why it is that shorter production processes that take less time and are less productive than longer production processes, which obviously take more time but are more productive, are ever used. If it wasn't for discounting, then investors would always invest, because the value of the capital good they're investing in would be higher, in longer, more productive production processes, but never in shorter, less productive ones. And yet shorter, less productive processes, in fact, we do see in use. This would be inexplicable if it wasn't for discounting. Okay, now, we want to mention that we have, at this point, a complete set of accounts, that are necessary for engaging in economic calculation. So profit, we see, is the framework within which the entrepreneur engages in his decisions about operational activity. Who he buys his supplies from, the amount of labor he uses of different types, and so on and so forth. With his existing capital structure, profit is the realm in which he decides on his operational decisions. And then we have now the possibility of doing what we might call capital accounting. And capital accounting, at least in this sense, is the ability that the entrepreneur now has, because they're prices for capital goods, not just rental prices but purchase prices, to construct balance sheets. In other words, to calculate his net worth. So because all of the purchase prices of all of the assets a firm owns are commensurable, these prices are all in present money, right? They say the value of its plant and equipment, the market value of it, is the discounted value, the present value of the future marginal value product stream that it will generate. Therefore, because it's in present value terms, it's commensurable to his cash holding, which is also in present terms, right? So he can add the value of his cash holding to the value of his plant and equipment, and to the value of all of the intermediate capital goods that he has, inventory and so on and so forth. All these things are made commensurable, precisely because in the market, the prices of all the assets are in present value terms. Without this, of course, you couldn't do balance sheets. You could not add up the value of cash, which is a present good, with the future value of plant and equipment. These would be incommensurable. So you get the possibility of making up balance sheets. And if we can make out balance sheets, we can calculate net worth or equity in the firm as the difference between the monetary value of assets and liability. Now, it's this calculation, it's this ability to engage in calculation based on purchase prices of capital goods that permits the process of capital investment to be economizing. Capital investment being that process of saving, investing, and building up the capital structure. So here we have the last link in the process of economic calculation that's done by entrepreneurs. So let's just talk through this process. Let's say we have Honda, and Honda for some reason engages in producing cars that are more demanded by the consumer. So consumer demand shifts to Honda because of the product they produced. So they're better satisfying consumer demand. What then happens is, first, Honda earns profit. If the profit goes up, the higher price for their output, same prices for their inputs. But something else happens too. Their net worth goes up. Their profit isn't their net income is added to their assets. There's no offsetting liability. Their net worth rises. So now Honda as a company is worth more. That is, their capital production process is worth more. And it's this then that calls forth more investment in that line of productive activity. So Honda says, okay, well, this is great. Our capital value's increased. Let's build a new plant facility. We'll build one in East Liberty, Ohio to complement our one in Marysville. And we'll just expand and produce even more. So when it's necessary for capital capacity to expand in some area of the economy, this is determinable precisely because there are purchase prices, that is, there's capital value for these firms. Now, this then finally leads us to the stock market. And you may know that Ludwig von Mises considered the stock market as the preeminent market of a capitalist economy. If we had one thing to look at in some historical economy to say that's in a capitalist economy or that's not a capitalist economy, Mises said it would be the stock market. Because it's on the stock market where this process of allocating capital investment, allocating the saving and investing to one process versus another is so to speak, perfected. It reaches its apogee. So, just briefly, stock is an ownership claim on the net worth of the firm. So when you own shares of stock, you own a pro rata share of the net worth of the firm. That's why stocks are called equities. Because you have a legal claim on the equity of the firm. So clearly, if a firm is better satisfying consumers, if it's earning profit and its net worth is rising, another way, of course, a firm can increase its net worth is simply to increase its market. They don't have to have more profit adding to their net worth. They just have to have a larger scope of operation. And then the difference between their assets and liabilities will be, normally, would be larger. This explains, for example, why Amazon.com can have a positive stock price when it never has a profit. Because it's a very large firm. And the difference between the anticipated value, that is the present value of the anticipated marginal value product of its assets, exceeds its liabilities. This is what, by the way, is noticed on the stock market, right? On the accounting books of Amazon, they may be carrying all their assets at book value. And so they don't show this increase in net worth. This net worth is only shown as an increase in a speculative market, where it isn't the book value of assets, that is the purchase price that you paid for them in the past, but it's the market value of the assets that counts. If Amazon were to be sold into the market, what would be paid for it? That's what is evident on the stock market. So, better satisfaction of consumer preferences and earning profit and growing size and so forth causes the overall net worth to grow, and thus with a given number of shares, the value of each share to rise. So stock prices go up anytime there's an anticipation that in the future there will be a better satisfaction of the consumers. Investors, of course, buy stock or sell it precisely depending upon their expectations of this future value of the firm, future net worth or equity of the firm. So the stock market then is the ultimate device for economizing the structure of production in society. It's the device by which capital investment is allocated across the different production processes and thus into their highest valued uses. Now let's turn back to this question that I raised earlier about the relationship between capital value and the rate of interest. We pointed out that the rate of interest will move all capital values across the economy when it changes. Not in the same proportion, of course, but all of them will move. And this has then two consequences, or there are two applications of this insight. One is in the theory of economic growth, in the very process of saving and investing. So let's first then talk through that, and then we'll talk about the second application, which is in the trade cycle, business cycle theory. So what constitutes the process of economic growth? Well, economic growth occurs when time preferences people have are reduced. And again, this afternoon we'll talk about time preference and its effect on the interest rate. So when people's time preferences are reduced, when their desire for present wealth relative to future wealth is lowered, then they save more. And the proportion of their wealth or income that they devote to spending on consumer goods and for present gratification, and the proportion that they save in order to have future goods is changed. Their time preference goes down. As a proportion, they consume less of their income and they save more. And of course, as time preference goes down, the pure rate of interest goes down. Now notice both of those factors will affect capital value. The additional funds that go into saving will be invested will be spent in the process of building up the capital structure. Of course, the only reason people engage in saving, denying themselves present consumption, is to receive a greater future consumption. This greater future consumption is reaped in the form of having greater production and more valuable goods produced in the future. Also, as we pointed out, the saving and investing process is not macro. It's not aggregate. The saving and investing goes into place in particular lines of productive activity, particular lines of the production structure. Automobiles expand, or the production of building construction expands, or the production of Mexican food expands, or whatever. So there's always a microeconomic process that's going on in saving and investing. And this is all dependent, as we mentioned before, upon profitability. So when time preferences go down, the pure rate of interest is pushed down. The amount of saving and investing, the amount of funds that go into investment expenditures increase. Both of these things raise capital values. There's more investment funds being spent on capital. Honda now borrows money because the interest rate's lower and the funds are available through the credit market. And they begin to buy capital goods, right? It drives the prices of the capital goods up. They drive up the price of steel and cement and so on and so forth that they're using to build their new factory. So capital prices, capital values go up, and the capital production processes which are based or which engage in the production of these capital goods also goes up. So the cement manufacturer's net worth rises because the demand for his product is increasing. So it calls forth an expansion in those production processes. More is invested in cement production and steel production, building bigger blast furnaces or more of them, so on and so forth, to satisfy the demand that's coming from the lower stages. So the production structure gets built up in this way, along particular lines according to the profitability in these lines of production. And the production structure is lengthened. Again, as we'll talk about this afternoon, time preference implies that the shortest, most productive processes will always be undertaken. At any point in time, people are already engaged in the short, highly productive production processes. The only things that they have not yet exploited then are longer, more productive processes, because time preference always desires satisfactions in the sooner as opposed to later. So the production structure tends to be lengthened. Longer processes of production are undertaken. More stages of production, and so on. But this is all justified precisely by the fact that people's time preferences have gone down. They're more willing to wait now for the future gratification that they'll get from these goods that are produced over longer periods. So that's, in brief, how the process of economic growth proceeds. Now, let's briefly give an account of the credit boom that occurs in the business cycle. The business cycle is set in motion by central bank monetary inflation through a fractional reserve banking system. And the monetary inflation is spent through the credit markets as it increases the supply of credit. And this increased supply of credit has the same two effects that a reduction in time preference have. It increases the pool of saving, and it lowers the rate of interest. So without any change in time preference, market rates of interest go down, and the amount of funds available for investing increases. Well, capital values rise, right? We set in motion the same or a similar looking process. So now the Honda can borrow this circulation credit that's been created by the central bank and begin to build up its plant just as it would have if this was genuine saving that was provided by a reduction in time preference. So capital values rise. We get the same looking process that's going on in the economy, at least for a while. Of course, during some booms, we see an obvious excess. Right, as the current boom crisis cycle that we've seen in internet stocks. So we see excesses that could never occur if it was a genuine movement, downward movement in time preferences that was driving the investment, let's say, in dot-coms. That can only be done because the central bank can pump money into the economy through the credit markets indefinitely. And without constraint. Now, the boom that's set in motion by this monetary inflation is unsustainable. And it's unsustainable precisely because it contradicts or stands in contradistinction to people's time preferences. People's time preferences haven't changed. And so their spending in the economy is still in the old consumption-saving pattern. But the economy, the structure of production is being built up in a way that contradicts these preferences, in a way that's not being demanded by the consumer. So since money is the medium of exchange that enters into the hands of all people through the economy, once it goes through the banking system or through the credit markets and comes into the hands of people more generally, they spend it in the old consumption-saving patterns. When they do that, then with no other change, if we assume that there was no further credit expansion, then the buildup of capital values that occurred early in the boom would be reversed, right? We see a collapse of the pool of saving, increase in the rate of interest, losses accruing to the buildup of the capital structure that had been undertaken in the boom. Most crises periods, though, don't arrive so easily. They typically arrive only when the central bank is forced by some economic reality to quit inflating so rapidly. Sometimes this is because of inflationary pressure or other problems that arise. But as soon as the consumer preferences and time preferences gain the upper hand because consumers are spending in their old time preference patterns over the central bank inflation, the crisis period arrives. The crisis period, the capital values collapse, interest rates go up, capital values collapse, the spending on investment projects dries up. And you can see this in the dot-coms, right? Nobody's investing in the dot-coms now. And the capital values of these activities collapse and then must be liquidated. That is, the capital buildup, the physical buildup of the capital goods must now be dismantled. The firms have to go out of business, their assets have to be sold, and reallocated into some other use that has some profitable possibility. Of course, that can only be done if the assets are sold for pennies on the dollar relative to their value in the boom, right? This can only happen if capital values collapse. So that entrepreneurs can come in and buy these assets at very low prices and reorganize them into the structure of production. Because these capital goods in the buildup are specific to certain production processes, this is ever more problematic, right? So to speak, the boom is easy. The bust is hard because the physical nature of the capital goods that are built up in the boom cannot be simply reallocated to other processes in the bust without loss of productivity. Again, this can only be done profitably if capital values are left to collapse. If I have a few more minutes, I might then talk a little bit about fallacies of capital. Right? Okay. Let me mention just a few fallacies of capital theories that exist in the economics literature. One is that there's no concept of real capital. It should be clear from our discussion that there's no such thing as real capital or the real value of capital goods. All we have are these things. We have the enumeration of the physical capital goods. We could go to the Honda plant in Marysville and say, okay, there's a robotic welding equipment, and over here is some inventory of tires, and so on and so forth. We can enumerate capital goods. And then we have the monetary value of these capital goods. We find those in the accounts of the firm. So we know what the value of the welding equipment is, or the value of the tires, and so on and so forth. And we have capital accounts, right? We can add up these capital values. But that's all. There's no such thing as real capital. There's just the monetary value of capital, which is always in actual existing prices on the market. And we have an enumeration of capital goods. Now, if there's no such thing as real capital, there can be no such thing as the real productivity of capital, which, let's say, might be manifested in a rate of interest. Some economists argue along these lines. Again, we have only two existing things. We have the physical productivity of capital But the physical productivity of each capital good is incommensurable with the physical productivity of every other capital good. There's no such thing as the overall physical productivity of Honda's production process. So we can't use that sort of thing to generate an interest theory. The only other thing, again, that we have is the monetary value of capital. And again, this afternoon we'll talk about why you can't use monetary value productivity to have as a basis of interest rate theory. Another fallacy of capital theory that exists is that capital is some kind of a homogeneous lump. It's divisible into equally serviceable units. Again, clearly in reality we have one of two things. We have heterogeneous capital goods, which obviously aren't a homogeneous lump, and we have the capital value of these goods. But the capital value of these goods, again, is not divisible into equally serviceable units. Capital accounting makes all these capital goods commensurable in monetary value, but that doesn't mean that we can somehow subdivide this capital value into homogeneous units. No, quite to the contrary. Each capital good can only be reallocated on its own or in some subset or set of capital goods piecemeal. Honda can sell off its plant, or it could sell the whole operation, but this is not divisible into homogeneous units where they could sell off half of their capital value and then have that half that they sell off identical to the half that they keep. No, whatever they sell off would be a different set of capital goods from what they keep. Further, there's no such thing as a concept of social capital. This would be another fallacy. Where we accept, here the fallacy is not that we deny that there's such a thing as the monetary value of capital. No, we say, let's accept that. We have the monetary value of capital, not something like real capital. But we say that this monetary value can be aggregated for the whole economy, for society as a whole. So we say, okay, there's something like the value of all capital goods across the whole economy. Well, clearly this is a mistake because capital value exists only in a market economy, only where there are private owners of capital goods. Capital value can only exist, in other words, when you have private owners who sell to other private owners a capital good or a set of capital goods. Thus, there can't be anything like social capital because there isn't one owner of all capital. And even if there was, to whom would this one owner sell all of the capital? The capital can't be sold in toto, right? It has to be sold in sets of capital goods. So capital value exists only for those sets of capital goods that are actually sold on the market or are possible to sell on the market. And then finally, let me mention one other, that capital is not a permanent fund that's somehow embedded in the capital stock that renders perpetual interest income. So you take a investment in the stock market of $10,000, and then forever into the future, this capital investment renders interest. So capital is not some kind of a permanent fund that generates interest just by the nature of the process of bringing it into existence. Again, this view denies everything we said about time in production. It denies that there's time preference that would generate a discount of the value of this fund, its future value into the present. It denies that there's stages of production, heterogeneous capital goods, etc. The capital structure itself in total, the capital stock, cannot be maintained without saving and investing. It isn't a permanent fund that generates interest. The capital value of a capital stock would dwindle over time if there wasn't additional saving and investing to maintain it. And this additional saving and investing to maintain it is a separate decision from bringing it into existence in the first place. Again, all you have to do to recognize this is drive around Pittsburg, Pennsylvania, and you'll see the rusting hulks of these old steel plants down by the Allegheny River. That capital value is lost. It's dwindled away from